Next to me is Suzanne Yoon. Suzanne is a principal at Versa Capital Management. She has 15 years of experience in special situations, which she will talk to us about. And currently, she sits as a director for one of the portfolio companies, American Laser Skincare. Next to Suzanne, we have Michael Goodman. Michael is a founding partner and managing director of SSG Capital Advisors. He has over 15 years of experience also in special situations, and he has completed over 100 client engagements in the restructuring. Next to Michael, we have Dirk Savini. Dirk is a managing director and head of the restructuring and recapitalization group at Peter J. Solomon Company. Dirk has led restructurings, mergers, acquisitions, debt and equity raises, and a multitude of different transactions or different cases from Lear Corporation to Sunbeam to Dana, so some big names. Next to Dirk, we have Connor Tully, who was kind enough to fill in for us today. Connor is a senior managing director from FTI Consulting Corporate Finance Restructuring Practice. With FTI Consulting, he's based in New York. He has over 14 years of experience in strategic planning, merger and acquisition, advisory services, and the like. Again, he's worked on many different transactions, including Adelphia, Dana, DBSI, General Motors, a lot of names we are all familiar with. And then finally, at the end, we have Albert Cass, who is a vice president at Kurtzman Carson Consulting. Previously, Albert was a lawyer with Kirkland & Ellis, working on debtor cases, committee cases, and he worked on, again, some large engagements, Calpine, Collins & Aikman, Solutia, and Wellman. So those are our panelists today, and we will start first with a brief look at the history of 2012, but then quickly go into 2013, because I think for many of you in the audience, whether you're an investor or a professional, we all want to know what's going to happen in 2013 and where we're going to be spending our time and where we should focus our efforts. So Michael, I'm going to ask you to kick us off and really give us a little bit of a historical perspective on where we are.
Sure. I'm going to answer that in a couple of ways, and each way kind of may dictate a different road ahead. But I remember a few years ago, I was talking to someone who runs a mainstream healthy M&A sell-side investment bank. And I was asking, why don't you have a restructuring practice? It seems so logical, it's counter-cyclical to your business. And his response was, if you look at history, really one every 4 years is a down year and is good for, down for my M&A sell-side business and a good year for the restructuring business. And I kind of thought about that, and it was kind of a sobering view of our business. And then you kind of pull back what you've learned from history, your history books back in high school, which is very regular cycles. There's the panic of 18. Don't worry, I'm not going back this far. 18, 19, and 20, and so forth and so on.
Yeah.
So right, and now up to 7th grade. But so kind of it sort of fits. History does fit that sentiment. And so when you look at where we are today in the midst of what has been pretty regular cycles for a couple hundred years, we're in a very logical place. We're coming out of a recession. The banks have actually done a pretty nice job of cleaning up their portfolios, so there's not a lot in these in the workout groups, which has resulted in not a lot of distressed activity for the professionals in that space in 2012 and going into 2013. Interest rates are low, which is very logical, which is why they would be low coming out of this recession. And again, we're growing. It's not the growth that a lot of people would like to see, but we are on track and kind of where you might expect us to be, generally speaking. There's all this liquidity, which is, again, a logical outgrowth of the lower interest rates. So what you're seeing is a pretty quiet, distressed M&A market, a pretty quiet restructuring market, but you see the picture being painted for a repeat of history. So what's going to happen with all this liquidity? It's going to be what always happens with excess liquidity. It's deployed into the economy irresponsibly. Lenders start to compete with themselves, and structures deteriorate, and all of a sudden, can I say this? Happy days are here again. As a restructuring guy,
yes.
let me
or distressed investors, yes.
So, from that view, very logical where we are. And from that view, you could say very logical where we will be going in the next couple of years. But then I also kind of think of another view, which is, up until recently, I said, well, the cycles have compressed, and because our business slowed down, and then all of a sudden you had the debt ceiling a couple of years ago, and our business picked up, and then you had droughts in certain segments, our business picked up, and it was this and this. I'm like, the cycles have compressed. And it got me thinking a little more that maybe those aren't cycles at all, that we now just live in a world that is so interconnected and so much more sensitive to various things that are out there. Ineptitude in Congress, globalization, issues in Europe, issues in China, global warming and drought, terrorism, so that instead of these regular cycles, we may be in a period where we're just lurching from event to event, which that's the case, then the answer where we're going is, no one knows, and it's impossible to know, which would make this panel kind of boring. But anyway, so that is two views of where we are.
Well, I think, too, to Michael's point, there has been a significant increase in capital flooding, and I know they talked about this a little bit in the last panel, flooding the United States, because despite, I think, the recession here, it appears that globally the U.S. still seems to be the most stable place to put your money. So you've got a ton of European money flooding, and everybody's chasing returns, although interest rates are zero. So you've had all this capital flooding into the market over the last year. So companies that maybe should be restructuring aren't. I think we're going to continue to see that. And I really can't tell if that's the norm, to your point, or if that's just the cycle. Because what we've seen is high yield's been at an all-time high year over year since 2010. And the investment into the equity markets is decreasing at the same time. So it's, it's a little bit, I feel like we're kind of in a conundrum because we have all this capital in the United States with no growth.
And just to put that into perspective, and I've seen different numbers, but I'll kind of pick the midpoint. I've seen reported that there's at least $450 billion of undeployed capital sitting with private equity funds. So there's a lot of money just with the private equity funds, and then obviously lending now is certainly loosening up. So I guess for those funds who were in the distressed area looking for deals back in 2012, what were they doing? Were they actually investing in anything?
I think it's been a lot of money looking for looking for the deals that just aren't out there. So they've been sitting on the sideline, I think, for the most part, not as busy as they would like to be.
And then I think at least I can say, from my perspective, it seemed like there was a little bit of a flurry of activity at year end. Maybe that was just special situation, tax-driven, something like that. But I don't know if other panelists saw that as well.
There seemed to be a pickup in some of the distressed M&A activity year-end, and I think that's actually a common occurrence. But if I were to characterize 2012 distressed M&A activity, first of all, you have to recognize the inextricable link between restructuring activity. A lot of these distressed sales come from restructurings, either the sale of surplus assets to help fund a transaction, or the sale of a company in its entirety through a 363 or through a plan process. And so when you think about 2012, you think about what were the driving factors of restructuring activity. And I think about, or I should say the constraints to restructuring activity. And I would say two words, liquidity and then uncertainty. Last year was a record issuance of high yield and leveraged loan volume. And so that, when you look at where all that money went, most of it went to refinancing. A little bit, to a lesser extent, it went to some dividend recaps. There was also some sponsor-to-sponsor transaction that happened that was financed, but almost all of it was refinancing. And so that took some risk out of the cohort of companies that we all look for restructuring activity from. So a lot of liquidity meant less restructuring activity per se. The other thing was uncertainty, and that affected some sectors more than others. Healthcare, for instance. There were some things that happened from a policy perspective and regulatory perspective that happened in healthcare that destabilized certain credits like skilled nursing care facilities. A lot of them had troubles once Congress came out and passed a reduction in the reimbursement rate. There are a number of companies in the for-profit education area that are financially unstable. And investors are staying away from that because there's a lot of uncertainty about whether or not the Department of Education is going to come in and reinstitute certain policies that are going to make it difficult for these companies to survive. And so the regulatory and policy issues, I think, stopped a lot of people from actually addressing their issues, and the liquidity actually just pushed some things down the road.
From our perspective, you really had a lot of deals where you were prepared to file for Chapter 11, and the 11th hour there was just money available. I mean, it didn't even a lot of times make 100% sense that there was money available, but the restructurings just never happened. The Chapter 11 was just never filed. It was kind of left on the shelf waiting to happen.
Yeah, I guess what we're seeing is pretty much that same trend of liquidity bailing out a lot of companies, and then also something we didn't really focus on was the fact that the lenders are still with interest rates near zero, kicking the can down the road. So I mean, I think 12 was a little slow. I think we would all agree, and that 13, I think you see some picking up in the market, but I think there's a situation now where we've been in this several years of just like a stagnation where interest rates are near zero, and really I think something needs to happen. Something needs to break. Either rates have to come up, and that'll flush out a lot of the weaker borrowers where they won't be able to handle their debt payments anymore with rates increasing, or you may have another event where you go back into like a recessionary period. I think for restructuring professionals in this room, this stagnation doesn't really help us too much. It's like make up your mind economy, which way are we going to go here? And I think once that happens, it may be towards the end of 13, I think there'll be a lot more activity, a lot more changing hands of assets, the weaker people falling out, acquisitions, some rolling up and consolidation in industries that Dirk mentioned, in either healthcare, you see energy assets. There's a number of sectors. I think defense spending is another one where you have these defense suppliers who have been kind of getting away with not being as efficient as they could be over a number of years with defense spending being high, but now you have that being reined in. I think you see a lot of those players getting a lot weaker. I think there'll be a lot of consolidation in that space.
So I think I heard you say, I guess, a couple of things, which is that if, unfortunately, which I think we all know, distressed investing market's been pretty slow, partially driven by low interest rates, but then you also went on to say you're thinking there might be an uptick towards the end of 2013. So maybe interest rates go up. I don't know about that, but what else has to happen to actually jumpstart the distressed marketplace?
I think that going back to my cycles is everyone on this panel and everyone in panels all day, liquidity. There aren't restructuring opportunities because these companies are all being refinanced. Large cap companies with access to the junk bond markets, middle market, lower middle market companies with access to bank funding, with access to these BDCs that, a new one comes out every day, with the credit-oriented hedge funds, which were in the market big time before the recession, exited fully, and are now back. And the question in my mind is, as we look out into the future, is, again, going back to that liquidity has to start to be deployed irresponsibly, which happens every cycle, and building our backlog for future deals where they're, again, covenant light, my favorite words, airball and over-advance, and all these
Everyone's
good,
favorite words.
all these good things, 5, 6, 7 times leverage deals for a restructured EBITDA in a cyclical industry. I mean, you saw that all day long in 2005, 2006, 2007, and those were all the deals that we worked on in 2009, 10, and 11. So I guess when we look at where we are from a calendar standpoint, whether it's 13, 14, 15, where it'll come back, is of course statement, but is the money dumb yet?
I mean, I think actually even more fundamentally than that, institutions just had to have been lending. And it's usually a 3 to 5 year cycle after there's a big peak in lending that we start to see a lot of defaults, right? And the distressed environment gets a little busier. 2009, nobody was lending. So I think people started to lend money, at least at the banks, in 2010, and really we started to see a significant pickup in 2011 and 12. We were actually really busy doing recaps this past year versus exiting deals. We bought some deals, but most of that happened because we started working on them in 2011. So, my sense is based on what's going on. I don't actually think anything's going to happen. There's not going to be a big downturn in 2013. Actually, I feel the opposite. I mean, consumer sentiment is coming back. The Dow hit a high yesterday. I think there's a lot of talk in the market with manufacturers about reinvesting into supply chain, which is really important in the United States based on consumer demand. So I think 2013 is going to be very slow through the rest of this year, and we have to really focus on either getting into deals via debt or really looking more at special situations, which are always kind of in the market, so divestitures and people wanting to get out of their investments for just purposes of getting out of their investments. I think versus being forced to sell because they're in a liquidity crunch.
Yeah, I agree. I don't think with Michael and everyone else, the money isn't, I don't know if I'm going to say this, isn't dumb enough yet. It's not, we're too close to what happened a couple of years ago. And I think that with interest rates so low, you're going to see a slow time for at least through this year, I believe.
I agree. I mean, you are seeing all these new lenders, you're seeing all of this liquidity, and you are seeing the envelopes starting to be pushed as it relates to covenants. Banks who wouldn't touch lending against fixed assets are now doing that a little bit more. Leverage multiples are creeping up, but to me, it's not at the point where it's irresponsible yet.
So no one's on the dark side here on this panel. Maybe I'm leaning a little on the dark side, but a lot more optimism up here than you'd expect from restructuring folks.
I think that we, all of us are responsible for this. I think we sometimes unreflectively lament the fact that there's this dearth of restructuring activity. Well, we've been here before. Mid-cycle troughs are not something that are new. We've all survived through it. And frankly, while we exist under a larger number of banners, the same people are really doing the same thing, be it on the investment side or the advisory side. The investment side, there truly are more dollars chasing deals. But that's consonant with the fact that we've had an enormous explosion in the size of capital that could be restructured. And so while some of us look at the default rate and say, woe is me, we're at 1.8 or 2.4 and the average is 4.6, you have to consider that average of 4.6 goes all the way back to the time when the combined debt in the bond and the leveraged loan market was a mere fraction of what it is today. And so 2% of the size of this market on an outstanding basis, from a dollar value perspective, is quite a bit of debt to be restructured and invested in and worked on for all of us. And so at least that's what I try and tell people on my firm, that this is a good thing. You should be investing in restructuring. To Michael's point on the fact that we're building some inventory, it's unquestionable. You look at the pro forma leverage statistics, you look at the price multiples that are being paid, and you can see a direct echo of what happened from the period of 2004 to, say, 2007. We're not quite there yet. None of us can tell you what the trigger is going to be, but certainly we're building that inventory. Something that I think some people missed this year was last year, 2012, was the first year that downgrades have actually outpaced upgrades since the recession. And so we had 3 consecutive years where you had more upgrades and downgrades. It's changed. And why is that? Because the composition of debt that's being issued is increasingly riskier, call it B+ or lower rated paper. And when you look at the cohort, and this is what I focus on, when you look at the cohort of debt that's B- or lower rated, and then you consider how much of that is trading somewhere in distress land, that's really the inventory of things that we have to work on, and it's pretty considerable. Now, it's shrinking a little bit, but it's out there for us to work on.
One of the other big drivers that everyone seems to talk about in a low interest rate environment is, oh man, when rates go up a couple hundred basis points, all these companies are screwed, and that will drive our business. For that to happen, you need the aggressively structured deals that can't afford, a couple hundred basis points of increase in rate. And I mean, the one counter to that is, this Fed has proven to be pretty conservative as it relates to rates. You kind of get the sense that they're only going to go up when many, many economic indicators are pointing in the right direction and the economy is on firmer ground. So is any increase in rate going to be countered by just a general improvement in the fundamentals of these businesses, because it'll be concurrent with improved economy?
And Connor, do you want to talk maybe a little bit about how the global factors are impacting distressed investing as well? I mean, we had just heard from the panel before us talking about opportunities overseas, but I think sometimes those people with money overseas are now looking at the U.S., which is probably one of the best places to invest.
Yeah, no,
how that's impacting our world as well.
Sure. In the last, I think historically, foreign investors were reticent to get into the U.S. distressed markets. They weren't familiar with investing in bankruptcy cases, 363 sales. They weren't familiar with the risks they were taking. They were, just for lack of a better term, nervous to get involved in these types of things. They'd rather look more towards healthier deals. But I think that has changed in about the last 12 to 18 months. A couple of things we were involved with where we're seeing Chinese buyers get very aggressive coming into the U.S. There's certain investments made in sort of the new economy, alternative energy, solar panels, those types of assets. And considerable investments were made. You could look at, Hawker Beechcraft doesn't really fall into that camp, but there was a Chinese buyer that looked at that, and ultimately they went the way of a restructuring. You have A123 Systems is a battery company. A substantial amount of money flowed into that company for electric vehicles. Chinese buyer was interested there. That brings you to an issue of this what they call CFIUS approval, and that's something people should be aware of as foreign investors come into the U.S. There's a committee on foreign investment in the U.S. that looks at these types of deals for national security purposes. I think the Hawker Beechcraft deal would have never gone through because of there was real national security defense issues there. A123 Systems, it was an issue. They went to get the approval. It took a while. Ultimately, that deal closed, and the foreign buyer ended up buying the assets. So, I guess the upshot is that we are seeing, although China as a country, I think, is falling into its own problems, you do have some of the Chinese corporates that are looking at assets in the U.S. and seeing tremendous value here, seeing all the money that was invested in technology and intellectual property, as well as the hard assets, and picking these assets up for pennies on the dollar. I mean, I guess it's good from the seller perspective. The people that are competing to buy these types of companies, I'd say maybe have a little bit of an advantage because of the approvals that are necessary and the time it takes. If you can move quickly, you may be able to beat out these buyers. But, I mean, that's something that we're seeing, and I think that may continue.
I think this is actually a really interesting point, and it's a little contrarian to what I just stated earlier about 2013, but can't really ignore that the U.S. has a major deficit right now, which is allowing Chinese companies to come in and buy assets that taxpayer dollars have gone into, which is causing all these other political issues. But I think, obviously, globally, despite our deficit, and that's actually presenting some opportunities for foreign buyers, because we actually looked at all the assets that Connor just mentioned, and the amount of capital that would have been required to keep the companies going or turn around, despite the fact that I think we had a pretty big drive to see if there was something we could do, was so large that only really another sovereign entity would have been able to take over those liabilities for the technology. I mean, and that really speaks a lot to the innovation that goes on in the United States, and how we're viewed globally is that we still have the best engineering here. We still have, there's so many things that we're really on the forefront of, and I personally think it's really unfortunate that we lost technology to the Chinese, but
I think
I think it's going to continue to happen.
Yeah, one thing is if you happen to be, on the seller side in a situation like that, in particular with a company I'll just say from China coming in and maybe trying to buy your assets. We had a situation this past year where ultimately we did have a Chinese-based buyer win the deal, and they reneged. And trying to actually enforce the sale to get it done or get some damages out of them, because it did cause severe damage to the price on a go-forward basis, was really next to impossible. So I guess if you're somebody like Aversa who's based here, maybe your value's not as high, but maybe you're bringing some intangible value to the table in terms of actual deal follow through, making sure that deal really happens. Albert and Connor, I'm going to go back to you just a little bit on what's happening maybe in terms of structuring transactions in the distressed marketplace, because I do think the few deals that are out there, at least what I see, they're chased by everybody just because there's just not many distressed opportunities. And then ultimately, if the price gets too high, you get away from a distressed buyer. But what are you seeing any trends in terms of changes in structuring to either try to win the deal or make sure the deal is all locked up in some way?
Sure. I mean, what we're seeing is kind of one of three things. You're seeing the kind of, and I hate to use the president's name, but the Obama 363 sale case, the GM model, where you kind of are quickly taking the good piece of the company, you're selling it to some new entity, and the restructuring really becomes about the pot of money that's after it. And for the investors and for people like you that are out there, it's really about getting that company, that good piece, sold sold and out of the restructuring as soon as possible. We are seeing a decent amount of debtor in possession financing that actually has dates itself in there. In other words, that by 30 days you have to have your plan on place. In 60 days you have to have this done. And whether it's an interest rate bump or they can pull the financing all together, it really does make for a fast track Chapter 11. It gives, I think, the investors a little bit more surety as to what's going to go on. I think people still, even with the American model of Chapter 11 and most of the judges being consistent, I think there are still investors there a little skittish about just this could become a free fall and my money could be tied up for quite a long time. The final thing that we've been seeing are a lot of exchange offers with a pre-pack option, which is basically asking the debt holders to swap debt for equity. If you don't get enough of that percentage up front, you're also asking them to vote on a prepackaged Chapter 11. Again, gets everybody kind of moving towards the end even before you start the filing, and we're seeing a lot more quicker Chapter 11s.
But I think that part of that is just because with more investors in the market and people have just gotten smarter about it. I mean, Chapter 11 is a very expensive process, so if you can have it pre-packed and organized beforehand, it's especially for a buyer. I mean, that's definitely the way to go. And I think generally people it's going to continue to go that way because unless it's a very large, complicated structure. For middle market companies to be sitting in Chapter 11 for an extended period of time, it just doesn't make any sense, particularly if it's a retailer with multiple locations. I just can't imagine that's going to change.
I agree completely. A lot of that is the different structures are driven by just a more sophisticated buyer universe. We talked about European buyers. I remember 10 years ago, you'd start to explain to a buyer the benefits of a 363 sale, and they kind of hang up on you. Now they're all familiar with it. The domestic strategics, they've all done it. Certainly the private equity funds, have always been sophisticated in that regard. So when you talk, literally this week we sold a company to a UK buyer through a state receivership. You'd never see them jump into something that messy. You see different institutions buying paper to maybe potentially circumvent bankruptcy or convert it through bankruptcy. And again, it's not just the smart private equity people, but now all the strategics are more attuned to our little world here.
I guess I'm not buying the concept that, in no disrespect here, the concept that investors are more sophisticated now. I think, in part, the reason we're seeing some of these pre-packs is because when we went through the last recession, you had all the companies that were commercially broken, more or less fall out and restructure. Then what you were left with was a cohort of companies that had bad right side of the balance sheets. And so when you've got a reasonably good company, but you've got a balance sheet on the right side that just doesn't work, then you can get together with a sophisticated group of people and reach a financial transaction that doesn't require the tools of bankruptcy. And so, I think that's good, but it's more reflective of the asset composition of the businesses that are restructuring today, as opposed to an increasing sophistication. Because I think that the investors have been sophisticated for a long time now. They've been doing this. I think back to a deal that Corinne, who was on the last panel, and I worked on, Dana. We had an ad hoc, one of many, I think it might have been, ad hoc group of bondholders, and they were very excited about essentially credit bidding their bonds and moving the company in and out of bankruptcy very, very quickly. They just said, look, we don't need this. Let's just go ahead. We'll own this thing. And there were a number of different things. There was an enormous amount of complexity, unwinding the good businesses from the bad businesses, dealing with the labor contracts and mitigating the cost for the go-forward business. Bankruptcy is there because there are companies that are just a mess and have a bunch of issues that need to be attended to, that bankruptcy is the best forum for. But if the investors, frankly, would have had their way, and they were all very sophisticated guys, this company would have been in and out of bankruptcy in 6 months and would have been back in 12 months later. There was an enormous amount that had to be done. Now, this in part has to do with investors are focused on, you're right, Suzanne, this isn't a very expensive process. There's a lot of people who are feeding at the trough, but sometimes you have to incur those. You look at Kodak as an example. Kodak is a bit of a mess. They're trying to unwind the assets, figure out how to maximize the value. A bunch of bondholders owning that mess out of bankruptcy probably isn't the right solution.
All right, Dirk, I guess to wrap it up, I mean, this thought, I'm sort of in between the two of you guys. I've thought for a long time there's been a trend.
You're over here, actually. Not
Yeah, on this comment, actually. But yeah, exactly. We've seen this trend of, quick 363 sales. I've felt for a long time your traditional fix-it in bankruptcy Chapter 11 is dead. I actually worked on Dana as well, and that was a peculiar one where there were all kinds of union issues, negotiating with suppliers, using that as a leverage point. But then you look at GM. GM was essentially a 28-day asset sale. So just to counter your point, I think that people are sophisticated enough now where they see the enormous costs of Chapter 11, and they figure speed may be better for us, and we can't fix every little bit of the company while we're in Chapter 11, but some good adequate planning on the front end. I don't think GM was done just on a whim. Obviously, people knew that this was going to happen, and there was a lot of discussion and negotiation and analyzing of the business on the front end to understand which plants they wanted to continue with, which plants they wanted to get rid of, which brands they got rid of. They got rid of Saturn and Pontiac and some pretty legendary brands, Hummer. But that was all planned on the front end and executed in a very short time frame. So my personal view is that your old traditional fix-it in bankruptcy Chapter 11 is there for that. Deal is dead, and I think that it's really just going to fix quick 363 sales.
I think I agree with that. I mean, we spend a lot of time with clients nowadays looking at a distressed investment opportunity when they happen to get one, looking at how you avoid bankruptcy. So we spend time looking at, if you were to file, what's the cost, what's the actual benefit, if you don't have a lot of leases to shed or things like that, maybe you don't get a bang for your buck in terms of the bankruptcy process. And then more importantly, I think for the distressed investor, if you go into bankruptcy, it's going to be a public auction process. So maybe there's a way you can do it out of court to actually avoid that, and as an investor, know you've won the deal. So if you're looking at that, you spent the time and money to try to get that deal, know that you're going to actually be able to execute the deal. And so we have done things through receiverships, strangely enough, which now I know how to do. I had never done those before. A lot of UCC foreclosure sales sometimes, assignments for the benefit of creditors, all sorts of things like that. And then I've also seen, there's obviously a ton of debt trading going on. I had a case where we actually represented the agent in that case. We had a 110-member bank group. We had a steering committee where probably 80 to 90% of the debt was consolidated, and I think our steering committee changed 7 to 8 times during the course of the case through debt trading until we finally got to all hedge funds, and then we did a debt for equity swap and took the assets. So I think you're seeing all these different trends in the restructuring area, which are really ways for distressed investors to try to figure out where am I going to best put myself in a position to actually win that deal, because there aren't many deals out there, and if I'm going to spend the time, I want to know I come out with that deal. And then one last comment, which I had, I guess, at least a successful 363 sale. I was on the company side where we had 4 bidders show up for our auction, so stalking horse plus 3. We had a strategic bidder that everyone was speculating was going to show up at that auction, and it was kind of driving the private equity fund interest away. But we actually had one fund who came in, and ultimately a private equity fund won the deal. But the fund came in and started thinking about and bidding with intangible value. And so, things like guaranteed jobs for the employees at the factory, for 6 months, guaranteed jobs at this factory for 3 months, guaranteed contracts with these critical vendors, for 3 months, a pot of money for the critical vendors, all sorts of things that is strategic. Actually, what that strategic was not sophisticated enough to react to in the auction. And so we actually went with a lower value bid, not taking the strategic bid because of all these intangibles that were piled on, and important to the company, important to the community, and got the judge to approve it. So I think you're seeing a lot of different unique ideas, again, to try to win the deal, all because of the fact that there's not much out there to go out and buy. So I think, Dirk, I'm going to turn to you now. So you've been a little bit of a pessimist, but I'm going to ask you to talk to us a little about where you see distressed M&A activity over the next 3 quarters, and where, are there going to be industries where there's some activity? What segments of the market, like the upper parts of the market, lower middle market, where would you be, what would you be looking at, or where do you see some activity?
So I'd say there's going to be more distressed M&A activity probably in the middle market than in the mid to large cap area, simply because of a lack of capital that's available to these companies. They're forced to restructure, and oftentimes the answer is a sale. If I had to talk about any specific sectors, I would say that having looked closely again at the composition of debt out there by industry sector and then by rating, it's clear that the most risk really resides in 3 sectors, and they are media and entertainment, technology, and healthcare. And so those are areas that people ought to focus on. And what I mean by that is, if you look at these entire sectors and you look at the average rating of debt issued and debt outstanding, and you look at whether or not they're on credit watch for downgrade, and you take into consideration all these things, S&P has a report called The Weakest Link. You should take a look at that. You'll see that these sectors overexpress in terms of high risk. And as a result, these companies may be forced to sell non-core assets or ultimately go through a sale of the company in its entirety. The other thing is, you can't just look at themes, industry themes, because there frankly aren't that many, and even the ones that I'm talking about are a little thin, because there's not a lot of value in there in terms of potential value of restructured debt. But you should look at the characteristics of certain companies. What we've seen over the last 12 to 18 months, writ large, are companies that are experiencing technological obsolescence. So that's something to keep your eye on. The other thing is companies that have significant labor contracts that they have to deal with, and the obligations related to these contracts are growing. So the municipalities come up when you think about that. You take a look at Hostess. The bread's not getting obsolesced, but yeah, you've got some problems on the labor side. So these are the big, messy bankruptcies, and those issues are really best addressed in bankruptcy. I talked a little bit about the for-profit education area. That area is probably going to see some restructuring. You already see it in the publishing business, where a lot of the textbook publishers are now losing market share to online work. And so it's probably another area that bears looking at. There frankly aren't that many public for-profit education companies, so you might want to consider the not-for-profits. They're going to have to restructure as well.
And in terms of kind of if you're looking at deals, I think most deals are in the middle market. Like, what is the middle market to you? Because I think everybody has a different view of what's middle market.
Yeah, you're right. It's variously defined. I would say $200 million to $1 billion in revenue is middle market.
And then if you're looking at middle market deals as an investor, can the deals just be too small, where it's just not worth it to go forward with the deal, or Are you looking for do most investors look for particular deal sizes or?
Well, from our perspective, yeah, but it's probably a better question for Suzanne because she's on the investing front.
Yeah, I mean, I think generally you're going to find that investors bucket themselves into sizes. So lower middle markets, usually 300 million and below. We say we invest in the middle market, and that's 100 million to $1 billion in revenue for, and obviously that's a huge range. But $1 billion retailer is not the same as $1 billion manufacturer. So I think it really depends by industry. And you know, I agree with Dirk. I think the activity is going to mostly be in the middle market, and a lot of it is not going to come necessarily from banks forcing people out the door, but from divestitures of public companies, maybe subsidiaries that are puddling along and they need to get out of, need management teams, and just the typical, you know, I guess a non-cyclical distress that we see is always the bad management, family feuds, you know.
I agree with both of you in some respects, in that certainly in every point in any cycle there'll be industries that are distressed, and there's also unique circumstances that drive a special situation transaction regardless of what the economy looks like. But those are kind of, that doesn't make a wave, and I just don't see the wave coming in 2012, or I'm sorry, it's 13, right? 2013 or in 2014. I think a lot still has to happen for the big wave to come. And so during that time period, you really want to hope that you have a capital raising arm that's that's doing deals based on all this liquidity in the market, and you're just not, you know, sell side distressed M&A, or you're focused in some of the sectors and have experience in some of the sectors that Dirk mentioned, or, you know, there's more consistency, I think, in the lower middle market than there is in the large cap, because there's just less meat on the bones, less margin for these companies. So,
And also less capital available to them.
Right.
I mean, that's a big driver.
right.
I mean, Michael, I've known you for a long time. I mean, you're very pessimistic about our business. Come on, you got to lighten up a little bit. I'm going to give you a drink after this.
My wife may hear what I'm saying, so she needs to know that
You're
lean
managing-
times are coming. Yeah.
Managing expectations, right? Managing expectations. But Dirk, I think you nailed it completely with the industries we're seeing as well. I mean, it's those. The only other ones I would add is just the coal industry. That's been a long story right now, where natural gas prices kind of in the tank. The coal businesses are just dying, both on the electrical production side and just coal services. And the other one I mentioned before as well was just the defense contractors, the smaller middle market defense contractors have been sort of living on their laurels for a long time. Now that the spending is going to be reined in, I could see a lot of issues and consolidation with those types of companies.
It just reminds me of another sector, and that's the energy sector. And it
Yeah.
really has to do with the low price of gas. A lot of people believe that it's bouncing along the low point and that there'll be some recovery in natural gas prices. And so there are a bunch of assets out there that are frankly very, very cheap and represent good option opportunities. You're seeing all of these coal-fired plants in the merchant power industry that are all being restructured. So I think there's going to be a lot of sales in that area.
Yeah, I was at a dinner with some of the people out in this room last night, and a lot of the discussion was about the brick and mortar retailers and whether that industry can really continue. Although, we had a lot of opinions all over the place. Whether or not that's a restructuring or that's just a dying breed is an interesting question.
And then I'm going to shift gears a little again and throw this out to the panel. So there's not a whole lot of deals out there, right, for distressed investors. So how's that impacting fundraising in the funds? Are there still new funds coming into the space? Can they raise the money? How's that changing?
Well, I do think that investors are still looking for returns, and they're looking for them in any way they can, as seen by the number of BDCs that have entered the market. What we've seen is actually a lot of foreign investors, even in the private equity space, coming to the U.S. looking to put money to work. And there are I think there are a lot of people out fundraising this year, and I think it's going to be interesting because there is still a lot of capital that also needs to be put to work. So what I've seen is actually a lot of funds that are that have a substantial amount of funds left to invest but are still out fundraising because they're trying to take advantage of the liquidity in the market.
I still think you might see a little bit of a shakeout. I mean, there were very few distressed funds in the 90s. Then all of a sudden this wave of fundraising for whatever concept you wanted. You could raise a fund in 05, 06. So, you know, our list went from very few people to many people who would look at a distressed deal. But, you know, the timing of raising that capital was not good. So, you know, if you've been in the business through multiple cycles and have a good track record and a good brand, you know, you'll always be able to raise money. But some of these funds that materialized in the last, you know, 6 years or so may be going away.
And it is much harder for new funds to raise money because the barriers of entry have increased, primarily because of the Frank Dodd Act. So I think, you know, the amount of money that it takes and really manpower for a private equity fund or even hedge fund to for regulatory reporting has increased so much over the last 2 years that I think that's actually become a barrier to entry into the space.
All right, so I'm going to just, I think we're getting close to the end, so I'm going to just throw out the last question for our panel. So all of you can give your predictions on the rest of 2013, and if you're a distressed investor, where should you focus your efforts?
Okay, I'll start.
No one wants to answer that,
I'll
yeah.
jump at once.
I do think it's going to be pretty slow. You know, I would say the industry, I think all the industries that were mentioned, there's always going to be pockets. I think one other place that we've been focusing is really the commodity, you know, general metals commodities, because the copper prices are going down, steel prices are going down, primarily because China isn't building as much. So I think we're going to see a little bit of shakeout there potentially this year. So
I think you should access all this liquidity, over-lever these companies, pay a huge multiple, and call me in 2 years.
And Dirk is silent.
You know, one of the concepts that I brought up, the for-profit education area, I think that's an interesting area. I've seen investors be very, very successful in situations where they roll up their sleeves, they really get knowledgeable about a sector, invest a lot of time, and then they pick their horses. And the examples of restructurings in this space are scant right now. The one that actually happened was a bit of a mess, but I think it can be improved upon. I think that right now the policy coming out of the Department of Education is going to be a little bit against some of these assets or some of these investments, and so spending some time perhaps in Washington trying to figure out which way the policy's going might be a way to pick some winners. But you look at the challenges and the crises we have in the education financing business that we have in this country, it's the next municipal issue.
Yeah, I guess this panel really, we talked about distressed investing and really on the principal side, taking a 100% position, buying a company out of a 363 sale. Yeah, there is a lot of money out there that's doing other things too. They're investing in distressed securities, and you know, when those bonds and investments start to go bad, I think you will see more and more of these you know, kind of lend to own through the bonds type structures where, you know, someone might do a rights offering. We saw that in Cooper Standard. I think, you know, Dana in essence was a rights offering, I think, at the end of the day. We're seeing that a lot more where, you know, it's not one buyer coming in, taking a control position, buying a massive company for a cash check, but instead using the bankruptcy to effectuate a transaction where they end up, you know, owning the equity through their bond investments and maybe putting up a little additional money in terms of a rights offering, which really it's an M&A transaction as well. It's just not in the vein that we were really talking about today. You could see a lot more of that towards the end of 2013.
Yeah, we've actually seen that's a good point with the rights offering. We've seen a lot of rights offerings in the last 6 months. It's a great way to get new money into a restructured company. I would say, and I'm echoing everything that this panel has already said, it's going to be a slow market. I do think the healthcare industry is an interesting one for the next 6, 12, 18 months.
All right, I'll thank all the panelists and turn it over so you can get on to the next one.